Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are continuing with our FM Pre-September 2024 mock exam. This is the very first question of your section C. Let's get started with it. So here is Star Company. You are given with the scenario as well as the requirements that you see on your screen over here. So the requirement one wants you to calculate, number one, the cost of equity of Star Company before the expansion, and you also have to explain your method. Secondly, you want to calculate the TERP of the equity share of Star Company, assuming that the option to issue rights shares is chosen, explaining your calculations. The weighted average cost of capital of Star Company after expansion, assuming that the funds are raised by the issue of loan notes. So you have the requirements and you see how ACCA is changing their patterns. Side by side your numerical explanations, they also want you to explain your workings. You should know what you're doing. You should not be doing it without any solid reasoning. Everything that you do should be concept based and you should be able to explain that. All right, so now let's have a read at the scenario. Star Company, a listed company engaged in manufacturing and selling of home appliances. It distributes the appliances through its own retail showrooms established all over the country. The company is currently all equity financed. Globe Company is engaged in a different business than Star Company is considering as a project. Its current capital structure comprises of debt is to equity of 50-50 and its geared beta is 0.85. So this is the information that we have so far. The shares of Star Company are currently trading at $5 and there are 200 million shares outstanding. For the year ended 31st December 20x4, the EBIT stood at $66 million. Its PE ratio is currently 20. EBIT is estimated to grow by 20% due to the expansion into the new markets. For further expansion, Star Company is contemplating to invest $200 million. After some discussions in a board meeting, the following alternative sources have been identified. So this pertains to our second requirement. Now let's solve the very first one, under which we have to calculate the cost of equity of Star Company before any expansion is taking place, and we have to explain our method also. So firstly, to calculate the cost of equity of Star Company, you are going to say that your existing cost represents only the cost of equity, as presently you do not have any debt. It's written over here, it's currently all equity finance. So presently we do not have any debt with the company. Now the cost of equity of the Star Company can be calculated using the CAPM method, over where we are given with the information. Let's see, risk-free rate of return is given to you at 4% and the cost of an estimated market premium is given to you as 7.5%. So we will be using these figures once we know the beta asset. So we know that we are given with the formula in the formula sheet also, the beta asset and beta equity relationship. So here is the formula right in front of you. Beta debt is considered to be 0. So only the first part of the formula right till here is our formula. So beta asset equals to value of equity divided by value of equity plus value of debt into 1 minus t multiplied by beta equity. So how can we find out the beta asset over here? We need to find out the beta asset, which will be given by your value of equity. Equity, as you saw, the ratio that was given for Star Company, Globe Company, is given to us as 50-50. So we can say that the value of the equity is 50. This needs to be divided by the denominator that we have, divided by 50, which is the value of equity again, plus 50 into 1 minus t, your tax rate, let's see, it's given as 25%. So 100 minus 25 gives you 0.75. So 0.75, you can simply say that this is your so far figure that you have calculated. Now this entire figure needs to be multiplied with your beta. This entire figure needs to be multiplied with the beta that is given to us over here. Let's see, it's given to us at 0.85. So we will find it that it's roughly 0.49. So let's reduce the decimals to two places. So 0.49 is what the beta asset is coming out to be. Now this we will be using to in the CAPM formula. According to the CAPM formula, the cost of equity is going to be nothing but what we have as the risk-free rate, which is given to us at 4%, plus we have the market premium also given to us 7.5%. This needs to be multiplied with your beta asset. Now this will give you your final answer. You can convert it to a percentage figure. So 7.64 is the cost of equity of this specific company, star company. So this is what the first part has been solved as. Obviously, when you have to explain, you'll be writing up all of this in the explanation, that we are assuming that since Globe company is a similar company to Star company, that's why we are using the the values of this company, the geared beta as well as the debt and equity structure, and then we are finding out for a beta asset, because currently the company is all equity financed. That's why we are finding it out for the beta asset, and then we are using that in our cost of equity calculations. So this is what the first part is going to look like. Now moving to the second part, wherein you have to give the TERP of the equity share of Star company, assuming that the option to issue rights shares is chosen, explaining the calculations. So like we were reading, $200 million are being sought after, and then the first option is to make a rights issue to raise $200 million by issue of sufficient number of right shares at a discount of 20% to the current price. So already it's given to you that currently Star Company's shares are trading at $5. So you're going to give it at a discount. That means your rights issue price, this is the second part, that means your rights issue price is 5 into 1 minus 20%, because 20% discount you are offering. So $4 is your rights issue price. Now you calculate how many are the number of shares that you will be issuing. So number of shares will come out to be, how much money do you need? 200. And how much is the value per share? 4. So you're going to need to issue $50 million, 50 million number of shares. Now this is the number of shares that you're going to be issuing. Now this means that for how many shares do you already have an issue? 200 you already have an issue. So that means you're going to offer the existing shareholders to get 1 share for every 4 share held, because if you see the ratio, 200 divided by 50 is going to give you 4. That means you're going to offer an existing shareholder who owns 4 shares in the company, they will be issued 1 share for every 4 shares that they hold. So the TERP that we will be calculating here is now a very easy calculation now that we know the ratio also. So your numerator is going to be 4 multiplied by the current price, which is 4 parts. For every 4 shares, you are giving 1 more share. So 4 is going to be multiplied with your current share price. Just a moment. Yeah. So 4 needs to be multiplied with your current share price, which is 5. And then the remainder ratio is 1, which needs to be multiplied by the rights issue price of $4. So this is what your numerator is going to look like. And then division, you have 5. 4 plus 1 is 5. So 4.8 is what your TERP works out to be. Again, you're going to have to explain this. You'll explain what we have done so far. You'll just say that current price is $5. Issue price is 20% discount, so this will be $4 per share. Then you're going to say we need 200 million, so 50 million number of shares we need to issue. And then you're going to say that this is the ratio. 1:4 is the ratio, because 200 is already there, 50 more is needed. So 1:4 becomes the ratio. And then we use the TERP formula to work out the TERP. Moving ahead to the third requirement. Third requirement was to find out the WACC after expansion, assuming that the loan notes are issued. So issue of 6% loan notes at the nominal value of $100, pre-tax cost of debt is estimated to be 6%. The PE ratio will remain unaffected by the debt issue. The equity beta is now given to you. It will become 0.579. So this is what is provided to you. Now, very first thing that you need is the cost of debt. So your cost of debt is going to be 6% is what your loan notes look like, and then you're going to get the tax benefit on them. So 6% multiplied by 1 minus 25%. So this gives you the after tax cost of debt. You can convert it to a percentage, 4.5%. Now you will calculate the revised cost of equity. You'll again use the CAPM formula, cost of equity. Using the CAPM formula, your risk-free rate is 4%. You add to it the market risk premium, which is 7.5%, and then you multiply it by the revised equity beta, which will become 0.579. So this is what your cost of equity is going to look like. Let's convert this also to a percentage figure. So this is what works out to be your cost of equity. Now let's also find out the market values, because we need the WACC. So we also need the market values. So market value of debt, how much is it going to be? 200 million worth you're issuing in the market debt, and then market value of equity is nothing but $5 is the price, and you have $200 million shares in issue. So 1,000 million is what the market value of your equity looks like. Now you have everything that you need to calculate WACC. You can also calculate the total. Total will come to 1,000 plus 200. So this is the total value of the company. And then to find out the WACC is going to be in your numerator, we can go for the other approach. You can have this cost of equity multiplied by the proportion of equity to the total. This is first part, and then the second part will be the cost of debt multiplied by the proportion of debt in the total capital. So this is how you can arrive at your cost of the weighted average cost of capital for the company. So this is what your final answers are going to look like. With this, we are done with this part so far. Now let's move and see what are the other parts that are asked over here. Part B wants you to evaluate the possible impact of using of each of the financing method used on the wealth of a shareholders, and comment on the acceptability of each method. So let's work out some calculations will also be needed over here. Now let's see if the first scenario is if the rights are issued, if right shares are issued. Now, if this is the scenario, what is your expected EBIT going to look like? EBIT is going to be, let's read the information which is provided to us. So the shares are currently traded at this. EBIT stood at 66 million. Its PE is this much, and EBIT is expected to grow by 20% due to the expansion. So once we have issued the right shares, expansion will be happening. So EBIT is going to be 66 multiplied by 1.2. This is going to give you $79.2 million. That means this is the new EBIT that you're going to be earning. Now your profit after tax is going to be 75% of this figure, or you can say 1 minus 25%. Simply multiply it by 75% and you will get the profit after tax. So 59.4 million is what you are going to be left with. Now let's find out the number of shares that we have. Number of shares, we already had 200 million shares in issue, then we issued 50 more, so 250 million is the number of shares that we currently have. So our EPS is going to be 59.4 divided by 250. So this is what our EPS is going to look like. If you calculate it, it's going to be $0.2376. So if your PE ratio is still going to hold, which is mentioned that it's still going to be maintained, then your share price will be 0.2376 multiplied by your PE ratio, which is 20, so which is going to give you $4.75. That means currently your share price is $5, but if you go for the rights issue, your share price is going to fall to 4.75. So, and this will also fall below your TERP. TERP was 4.8, so this means that the shareholder wealth will decline and the share issue, rights issue, will not be acceptable to the shareholders. So this is what you will write here. And then let's consider the second scenario. If loan notes are issued, again, your EBIT is going to remain the same, but the profit after tax is going to look a little different because you have the interest expense also. So profit after tax will be 79.2 minus the interest that you subtract. So you're issuing 200 million and on that you're paying 6% interest. So minus 6% of 200, and then you'll also multiply the figure with 0.75 because you'll also be paying taxes. So if you work this out, this will come out to be 50.4 million. Now this is what your profit after tax looks like. Now number of shares is again the same because you're going for loan notes, so no changes in the number of shares. This remains 200. So your EPS is going to become now 50.4 divided by 200, which is going to give you 0.252. This is what your EPS looks like, and PE ratio is given to you that will remain 20. So your share price is going to become 0.252 multiplied by 20, which is going to give you 5.04. So presently your share is $5, and with this method, it's further going to rise up to 5.04. So this method will be acceptable to the shareholders. However, you also see that the financial risk will increase. So, the shareholders still have to see that the gearing is going up, so the company may become risky. But again, if you see the interest cover that is provided to us over here, let's read the question further. Yeah. So if you see how much your interest cover will be, let's work it out. Interest cover will be your EBIT 79.2 divided by your interest expense. Your interest expense is 12. So that means your interest cover is going to be 6.6 times. That means that this is something which is feasible for the company. So this is something which is acceptable to the shareholders, hence this method can be chosen. Now let's move on to the very last part that we have is we have to discuss the assumptions related to the CAPM model. Examiner is basically giving you a gift of 4 marks. A knowledge-based requirement for 4 marks is on your way. So the assumptions that we have studied for CAPM model, let's write about them. So I'm just going to give you the bullet pointers and you can expand them later. First assumption is that investors are holding well diversified portfolios. That means they are not just investing in only one sector, in only one company. They are holding diversified portfolios. That means the non-systematic risk is being removed. They are only subject to the systematic risk. So this is about this. And the second one is that the perfect markets are assumed to exist. That means, what do you mean by perfect market? That means that there are no taxes, there are no transaction costs. All investors have the access to all sorts of information and they are all taking rational decisions. Third assumption is that the risk-free rate, that means everyone in the economy, company as well as the shareholders, they can borrow at the risk-free rate. This is the minimum rate of return that they are expecting from the company. And last but not the least, we consider a single period investment horizon. Single period investment horizon. That means that you are only looking at one period at a time. This helps you to avoid a mismatch in the comparison of the returns. So these are the assumptions that we have in the CAPM model. With this, we are done with this question called Star Company. Stay tuned for the next video wherein we'll be solving the very last question of your FM Pre-September 2024 mock exam.